Well, good evening, everybody. Welcome to today's session. I hope you're well. I hope your Wednesday has been a good one. Let's just say thank you to you all for popping in today, and it's always a pleasure and a privilege to serve. And of course, as we do, please just remember that this is for educational purposes only. Please make sure you do your own due diligence on anything you see here. Make sure you follow trading plans on every trade, be that discretionary or, of course, make sure your plan is consistent with any automated trading you do. Make sure it's consistent with your personal trading objectives and financial situation. Of course, we are talking about risk today. I know it's not very sexy to talk about risk, but it's really important. And I think I've got some interesting things to share with you today. So thank you for popping in. What we're going to do, we're going to do a slightly shorter. We're going to do slightly shorter market wrap. We're just going to have a look around at some charts. It looks as though I'll talk through why the whys and wherefores as we go. And let's put that up right now. There we go. You should see a NASDAQ chart in front of you on the daily, and you can see really what's happened over the last few days. Bit of a tumultuous market. We had, of course, a little pullback from record highs at the end of last week, and then a significant move to the downside on Friday. Move up, and then, of course, we had a little bit of a soft day yesterday, and really sort of aimless today. A bit bouncy within throughout the trading day. We started off weak, had a good run since European sessions open. We just paired off a little bit. Very much similar in the US 500. Of course, we are in the midst of earnings season, which is why we're up near these highs, because we've got 82% of the 40% of the S&P 500 that reported so far beating EPS expectations, and a not too dissimilar number beating revenue. So all good to go. Now, of course, the US dollar was on a bit of a tear to the upside on the back of some trade agreements between Trump and various parties, including the Eurozone, of course. China's still in the balance a little bit. I think to August the 12th is their key date. So expect more narrative around that once it's stopped talking about Epstein, Jerome Powell, and whatever else is. And dodgy jobs reports um, firing them head persons. Anyway, that is what it is. But you can see what happened on Friday after that jobs report. Since then, we sort of flatlined on the USD. Really, the FX market has been not a hugely amazing place to be. On that US dollar weakness, we did see a bounce in gold, though, which is certainly worth having a look at. We are a bit soft today, but there's that big candle again bouncing off that support around about 32.70. And of course, hi everybody. Hi Wayne, hi Sonia, by the way. Thank you for everybody who says hi in the chat box. Um, so let's go back to where we were. Well, now I've done that. Gold has pulled back a little bit today. You can just see that really since the Asian Open, it's failed to push on through. Just fell short of 3,400. 33.90 it made it up to in yesterday's trading, but really didn't follow through on that. So I would suggest that possibly that high from yesterday is worth keeping an eye on in the short term. Maybe that high close around about 33.80. A push through that could see us re-challenge this 4 times failed resistance now at 34.30. And obviously anything moved through that could be significant. Copper, that's copper's down move after that tariff-induced drop. Of course, August the 1st, things came into effect. The markets preempted that a little bit after a chunk of buying beforehand. There was the pre-buying, there was the post-tariff position. And now we've sort of found ourselves in a range here. Watch 432 to the downside, watch 451 to the upside, I think. Oil has been under pressure a little bit, retesting the support, but has managed to hold $66 with a slight uptick today. Let's have a just a quick look at some FX crosses. Here's the Aussie yen, which has been interesting all day on the hourly chart. Just beneath the 200 MA now, but this level here at 92.96 appears to be a key level. You can see back here was important as well. If we look on the daily chart, you can see multiple tests of this previously. So 96 looks like a very important level for AUD. Potential 100 pip move to the upside. If you look at the longer term charts, slightly clearer on the 4 hourly, and this sort of is actually really quite a nice technical chart because the moves have been significant and in almost a straight line to the up and down side, really since about the 15th of July. So should we breach 96, I think this is a really nice chart to have a look at. It'll be a multi-time frame breach of 96, and therefore that should add weight to this. If we look at the Aussie US, again, this is sort of stuck. This is an ascending triangle formation here. Not quite as compelling as the upside. Possible move up maybe 20 to 25 pips. If we look possibly at the US yen, then you can see that yen weakness again just creeping in. That's the level of interest there at 147.90, which again is an interesting level. Possibly not much though in this, maybe again 15, 20 pips. If we look just there isn't much. Just watch for the crude oil inventories tonight. That's the major. That's the major event out tonight. Not much else out of the US, apart from some of the Fed members speaking. It's now virtually priced in that they're gonna cut rates in September. That's changed dramatically since that jobs report. Tomorrow's quite a big day just to keep an eye out on keep an eye on the GB pound, particularly. It's the Bank of England rate decision expected to drop by about 0.25% to 4%. And then we've US uh, got the US weekly jobs with it being a Thursday tomorrow, of course. So we'll just keep an eye on that sort of stuff as we go. But for right now, I'm planting the flag in Aussie yen. Um, there's two potential trades here. There's a breach of 96, or indeed there's the failure to breach 96 and a return back down towards 95.78. Very high probability trade to the upside because of previous price action. Wouldn't get too greedy with this. Would probably put a take profit of around about 60 pips or so, up to around about this 96.60, which as you can see here, there was a bit of pause on the way up here. And a little bit of a a little bit of support there before it popped down on that particular trend. In terms of just a couple to watch for tomorrow, the LYC we've been banging on every time I've met this week. There's LYC continues to push higher. Very, very strong indeed. I quite like the uranium stocks for a bit of a bounce, but has failed to sort of follow through on that in the last couple of days. But if we this IEL was an interesting move, or IDP education. I think there's a massive gap to fill this. These guys do international student placements as well as doing some English language teaching. You can see that is a key level that it's breached through up 12%. I would suggest that's um, probably a some corporate news come across there. It was a really good day on the ASX, record highs over 800 that we finished at. So gold stocks obviously doing really well in terms of that bump in gold. A couple of others possibly to watch. Watch the coal stocks, which are sort of looking interesting here. There's Yancoal, ticker code YAL. Just watch for a breach of 652. Of course, you can pop in, come back here tomorrow, and we'll do a live update at lunchtime. Be great to see you then. We'll have a look at what these are doing live. In the US, I quite like this bounce off for Boeing off 218. 225 could make its way up to 240. Outside of that, tech's been leading the charge as usual. Um, but of course, we saw that pullback towards the back end of last week. Microsoft, if bounces, could make its way back up to 550, and Mike's faves, Nvidia again. Now we're stuck in a short term range here, which is really quite good. Not only does it give a potential opportunity to accumulate here, but we've got a nice line in the sand at 181 that's worth keeping an eye on. Also, just wanted to pop up Delta Airlines. Stuck in a short-term range there. Watch for a breach to the top. And just checking in on LUV. LUV are not a place to go, but ultimately this could be a level where it finds some support, but I'm not. It was one that we sort of thought might bounce off the 200 MA, but hasn't. So we'll just leave that one alone. And home builders are doing particularly well. PHM were one we highlighted. You can see that if I just bring this up to date. There we go. So this is going to be my US chart of the day. It's Pulte Group Limited, Home Builders. 121 is the level to watch for. It was tested here and back here in January. If we put this on a longer term chart, you can see the potential upside on this, possibly to around about 135. So Home Builders doing well in the US, possibly even better because of that. I mean, it surged in terms of the likelihood after that jobs report. It was sitting around about 60%. Now it's at 90%, I think, if we look at the latest. So there you go. There's a few to watch, and we might check in on them at the end. Now, on to today's content. If you just give me a second to negotiate my way around all these screens. There we go. Right. Okay. So, as I said, it's not talking about risk isn't usually very sexy at all, but it is really important. And I've been doing some significant thinking on this. Now, again, just for clarity. So the reason for thinking about this, as I just take a drink, is really to do with the multiple EAs. Many of you know that I'm involved in running an EA program. And as part of that, we've been sort of looking at how do we better manage risk outside of the risks inside, but primarily outside the risks associated with specific trades. So within that and within your discretionary trading, we have stop losses, take profits, trading stops, position sizing, all to manage risks. So generally speaking, these manage most trade level risks, but not system level exposure. And there are a couple of trade level risks which aren't managed by these, to be honest. So that's what today is going to be about. Because what happens outside an EA or discretionary portfolio could be immediately more dangerous to capital or giving profit back to the market. Things like news events, correlated exposure, infrastructure failure, all things that we're going to briefly mention and can all be significant for both EA and discretionary traders alike. Now, even if you're a discretionary trader, it makes sense to potentially put some degree of automation in to manage this if you think that is consistent with managing your risk well. You already do that. You already put automation in if you put a system stop or a take profit or even use the internal system trail. It's just taking that to the next level. As I just adjust the lighting, make me look very scarily ghosty. So that's what we're going to do today. It's not going to be a massively long presentation, but I'm going to show you a couple of things that we're doing. And as I said, there's nothing wrong if you're a discretionary trader with looking at these things and even touching base and finding out what we're doing and how you can add that layer of automation in the background that's going to keep things safer. Because it's about risks not managed by your EA itself or those previous things like stops and take profits. and how EAs, or expert advisors, or automated trading systems, something called include files or library files, if you like, and Python scripts, which is another language that can pull information from outside, and external tools can help you in your goal to build a layered, resilient trading environment that stays robust under pressure. Of course, we can't protect ourselves wholly, but what we want to do, if there's something that threatens our as open positions, because that's what it's talking about potentially in the main, is make sure that we come out ready to fight another day without being too damaged. That's the aim, because there will be events of varying degrees of scariness that will pop up fairly regularly, some not so regularly. So the first one we're going to look at is really something we can manage. Um, we can manage with a combination of things, and this is event risk. Now, if you were a discretionary trader, you may decide to close positions down prior to particular events that are scheduled, or alter your positions accordingly. Now, that isn't so possible with if you're doing an automated trading system unless it's built in. And of course, a lot of these events happen late at night, and it might be that you want to protect yourself to the downside. But if the data is good and subsequently positions flourish, maybe you want to take advantage of that too. So this is about managing that. Um, and really, there are some data points which are high impact generally across markets. There are some which impact more significantly on some markets than others. But really, the bottom line is a deviation significantly from expectations, because theoretically, at least, most of which you see in terms of consensus um, of expectation is already priced in. The problem is that if it does deviate from expectation, we get volatility spikes causing slippage, gaps, exit blockage, and of course, the impact can cause rapid price moves, which, if we're discretionary trading, we can't respond to quickly, and possibly, of course, if you're operating on systems which rely on this on what happens or where something is at a bar close, then obviously that can impact as well. But what we're trying to do here is be proactive rather than reactive. We'll talk about the reactive strategy in a moment, but this is being proactive and saying, right, what we need to do is we need to find out which events matter and then do something about them, if that makes sense, before they actually happen. So, what we've been busy doing is creating a list of the major data points and doing a matrix of the major asset classes and the effect each one of those have. It's quite a detailed document, and there's modifying filters as well. But now we've got that essentially completed, what we can do now is we can pull down from um, many of you are familiar with Forex Factory or Economic Calendar, so we can pull down that data um, and say, right, okay, what data is happening today? What positions may we have open that are going to impact on that? And of course, subsequently decide what we're going to do with it. So we can then, if we do that, we've then got essentially some choices. We've got the choice of closing everything down before the event is before the data is released. For example, we can tighten a trail stop, perhaps. We can just decide to ride it out if the position that we have open isn't necessarily high impact for that particular data release right there, right then. Or we can do a trick called partial close, where we essentially, before the data is due, particularly if in profit, we would close down half of that and then trail the rest up. So what that does is it protects us to the downside while still giving us some upside exposure. So what we do is we pull this data down, and then we can manipulate it in what's called an include file, an MT5, and that can sort out whether it's high or low impact on the various positions we may have open and take the appropriate action, be it one, two, three, or four. So that's where it's going. So it's not just simply, right, we'll close everything down or write everything out. What it is a more systematic and thoughtful way of managing event risk. But bottom line is, it is managing event risk, which isn't otherwise in there apart from what you've got already in the system, such as stops, etc. So that's there or nearly there. Um, it's in the testing phase and it's looking really exciting in terms of what it could do. The second, although not a systemic risk per se, is what I'm terming a catastrophic candle, which is an unplanned shock. So unplanned shocks can occur from an unscheduled event or announcement. So, for a great example of this was the BOJ last year when they unexpectedly announced they were going to raise rates for the first time for a couple of decades. And of course, every yen cross went la la, being the technical term. Now, if exits are only triggered at bar close, the reaction is delayed, or if you're not there when it happens and you're actively, let's say, here's the scenario. So you've had a position as a discretionary trader, which has done well, it's doing well, it's going okay, it's doing well. And then all of a sudden, so you've made a fair bit of profit, and all of a sudden, bang, something happens. And then you've lost it and possibly then some, because then it goes down and hits your stop. Now, of course, um, you can manage some of that with trail stop strategies, but of course, you've got to be there at your system to be able to adjust those accordingly. It could be that you're not using a stop at all, and of course we have talked about that at length in terms of maybe even if that's your choice and you're looking for price action to say right this move is over or it's not working, then or indeed it's doing well, creates a double top and then comes down. That might be the way you're choosing to operate. I mean, A, you should still have a safety net stop, but B, that safety net stop is usually quite a way away from the price action. So we don't want to have a one candle bang if we can possibly get away with it. So these can cause extreme movements, extreme wicks, very fast markets. For example, that if we look at the US yen on that day, it dropped around about 450 pips in less than an hour. Most of that was in the first 15 minutes. So the solutions, there's a couple of solutions for this. You can use volatility monitors within the main EA itself or within include files. And what this says, if you want a rule, it would say that, well, look, if a specific candle has moved more than it normally has by a significant length, so perhaps if you say that one ATR is a normal range of price movement for a specific candle on a specific time frame, then a 2 or a 3 ATR candle might be significant. So let's just see if we can find one of those, just so you can visualize it. Oh, we need look no further than this. Let me just flick it back to the charts. There we go. So you can see there that jobs report, okay, on the US yen on an hourly chart. Okay, we can even put it on a 30-minute chart. You can see how fast it moved. If we look at a 5-minute chart, let's just go right back. I wanted to do on the shorter time frame. Was it that it wasn't there? Come on, Mike, get your act together, son. Maybe I overcooked it by doing it on a 5-minute chart. I should have just. There we go. There we go. So if we look at this move here, so 1, 2, 3, 4, 5, 6, 7, 8, 9. So 45 minutes, it dropped 236 pips. Okay. If we look to an hour, it's dropped 258 down to its low of 307 pips. Okay, 16 5-minute bars is about an hour and a quarter. Okay, if we put that on a 15-minute chart, there it is. So about half the damage was caused in the first 15 minutes. About a third of the damage was caused within the first 5 minutes. And probably about half of that was in the first minute. Okay. But if you're looking at a chart every hour to make a decision, you're bimbling here thinking, should I've done really well in this trade. Should I just see if it's going to bounce here? Um, okay, we're going to trail our stop. Okay, we'll do an MA cross trail. Okay, we've sort of got in here. Let's trail the stop. I'm just looking a bit of profit here. And then we'll see how this goes, and then we'll come back. Well, boom, it went down, and it went down with a vengeance. But all that didn't happen in one hit. And remember, this, of course, went on subsequently. So if we look at where it is by the end of the day, there's the period separator. We're down 340 pips, right? So if this was overnight while you were sleeping, and you hadn't got something in place, maybe you were trading the 4-hour chart and feeling quite confident about how it was looking on the 4-hour chart, getting quite cool about it. You'd sort of seen this, you'd entered it here, bush, and then it goes in less than 6 hours. Now, to put it into context, normal volatility. Normal volatility on this, if we look at the ATR previous, you can see average volatility is possibly somewhere between 23, 20, 25 pips, somewhere between 85 to 25 pips, depending on what time of day it is. 18 to 25 pips. 2 ATR. So let's say we had someone that put a handbrake on 3 ATR away. Okay, so 56 pips down. That would be there. So that would get us out at that point. If we had something that was bar close, or we were just popping in every hour just to have a look at things before we made a decision, we would have lost 252 pips. This is what's termed the catastrophic candle. So we've got two things in place to do that. We've got what's called the maximum give back function, and we have a handbrake as well, which is sort of under review, which is an automated system that says if intra-bar it drops more than X ATR, whatever you decide it is for you, and it's below the maybe it's below the 3 or 4 previous candles, then we're out. That's a handbrake. Okay, maximum give back would probably take us out somewhere up here. So that catastrophic candle is really important. If you're discretionary trading, you've got, even if you're not using a system stop for or a regular trail, you need a safety net stop in to legislate for this, because it can be massively damaging in a heartbeat. Hi, Roger, by the way. Excuse me, let me just have a drink. Okay, so that's where we're at. Now, back to our presentation. So that's our catastrophic candle and how we would manage it. So we'd have a trigger for that. So our trigger would be a move of X. Don't do it on points of pips, because then it's not transferable across different timeframes and different asset classes. Do it on a volatility measure like ATR, which is the simplest. So have a trigger and then a related action. And I said you can have an immediate partial close function and then see what happens to protect. I wouldn't use a partial close for a catastrophic candle, but now some people might. Then we get our black swan event, and this is a massive geopolitical, economic, maybe climatic. Is that right? Yeah, when it's a climate thing, maybe we've got a hurricane smashing through the US, or unlikely Central Europe, but or a structural market collapse, such as a GFC happening, or a Liberation Day happening, perhaps a war outbreak, flash crashes, Liberation Day, whatever it is. This is a whole market event where people are just scurrying to get out of risk on assets at a rate of knots. And it doesn't matter whether you've got multiple discretionary positions or multiple EAs with that are similar that are simultaneously exposed, um, the danger is fairly massive. If you've got, let's say, if you're a discretionary trader, you should have maybe something in trading plan that says we're not going to have more than 6 or 8 trades open at any one time. Let's say you've got 6 stocks or six or eight CFDs, and all of a sudden something like this happens within an hour, you could have wiped out your account. Um, the challenge with this is to decide what the universal trigger is to kill risk exposure. And probably the most obvious is to, you've got two options really. You look at what's happening in your account as an absolute. So you look at the exposure itself, which would be where is my equity now and what threshold in drop of equity would I have to have to make me want to trigger this. Um, and what we're thinking of triggering is a master kill switch. So what that does is it just closes every position down and maybe pause opening other positions if you're automated trading for a little while after, although that is less critical because, of course, with automated trading systems, you're looking for a particular entry set of criteria to say now's the time to enter. And if you're looking at long, that's not going to happen for some time if everything's dropped. I guess the reverse is the case as well. You may want to trigger a switch to the other side that says, woohoo, something great has happened. You know, the buy the news, sell the fact cliche. Well, it might be that markets have gone boom to the upside, and then the next response usually is a trickle down. So it might be that you want one the other a kill switch the other way to lock it in too. Although we don't normally think. I wonder if that's called a white swan event, just out of interest. Anyway, if not, we can make it up, can't we? Anyway, so the action is an instant close of all open positions. We're testing this out now, um, which is, as I suggest, based on a level of equity move within X time. So, for example, if you have a 20% drop in from equity, then you close everything out immediately. Oh, sorry, in 30 minutes, you close everything out immediately. The way we're testing it, obviously, at the moment is looking at a really small threshold and a really small and a really sort of longer time. So if it drops 5% within, if equity drops more than I think 3% is the one I'm testing now, 3% in an hour, then you're everything out. You could even do it 3% in 24 hours. So or 1% in 24 hours just to test that system. But that's nearly there. It looks as though it's fine. Um, but as I said, you've got to make a decision in terms of whether you close everything and then have a, if you like, a pause period where you can take a breath, see what's going on, find out what's happened, and then take actions from there, of course. Or indeed look to um, potentially take advantage of that. Another one is exposure overload. So this is an EA book or portfolio imbalance where it's really sexy to get in all the and I did this in my early days of trading. I used to find myself in 6 or 7 materials resource stock positions. They were the ones that moved. Now, I guess the current equivalent is tech. Um, with an EA book, it could be that you have because things are open different times. It's very common to have yen crosses, for example, that do very well with some EAs, and so or you might have a number of USD positions or USD related assets. And so let's say you have just accumulated 6 or 7 of these, because that's what your automated system does, or inadvertently as a discretion trade, just entered more and more and more, creating a large correlated hole, meaning that if something happens, then you're overexposed in risk on, risk off, or in specific asset classes. So let's say we got a big exposure to yen, let's use that, and then they did this rate rise unexpectedly, then of course, um, and that actually did happen. We had 6 yen positions open long when the BOJ announced that surprise rate decision. Um, but we can be more proactive than that, and I think that's the way to go. Recognizing that recognizing that we need to keep balance. We can first of all make sure that in our plan or in our EAs we have balance there. So in our plan, we might have in our discretionary plan we may have no more than 8 trades open, only 3 of which are going to be a maximum of 3 are going to be in any one sector. That will be an easy way to do it. From an EA point of view, you make sure that you've got a balance of long versus short, of yen crosses versus non-yen crosses, or majors versus minors, maybe a mix of some indices in there, maybe some commodities in there. So you make sure you have a nice balance of asset classes, timeframes, and direction. Um, the problem is, or the challenge is, so what we've done is we've developed a script that measures exposure, looking backwards. What was our exposure at a particular time, so we can see how the portfolio is behaving. Not a drama to create something from a discretionary side of things that looks at the asset classes you opened, perhaps split them into sectors and say, well, what exposure did I have in particular sectors at specific times? So, but of course, once we've done that, that's okay. But then we need to define a meaningful threshold when where it's going to relate it into some sort of action. So it could be exposure from a simple number, I guess a simple number open. It could be exposure in terms of dollars. It could be exposure in terms of lot sizes or contracts, depending on what you're trading, or shares itself. So there's a number of different ways of defining exposure, and coming up with the right one is it's combining that with the idea of, well, what is the state? So what is the state? What is the exposure that says now I need to do something? What's the trigger? So we can track open positions. We can say, right, we can do this automatically. So I can get a report, which I don't think it allows me to do on here, but I'll just test it just because of the OBS platform. Let's see if I can maybe open one for you. I'm wondering whether you can see this. Let me just check before I... Nope. I'm just going to try something here. Oh, look at that. Okay. So this is our exposure report. Okay. So let me just go to this. So if you look down, so what it's done is it's split up the. So this is analysis from the period prior to that yen, prior to that BOJ announcement up until July this year. So what it does is it says what's the maximum positions we had open at any one time, and therefore is that a high, medium, or low risk? Um, Now, if we this is really interesting because if we then look at what happened in those high risk periods, so that's a high risk period when you have more than 3 open at one time, you can see it rarely serves you well. And look, you can see the number of high risk periods in yen crosses. And that was the damage. Now, fortunately, outside of that, things did really well. But that was a big chunk of our profit given back because we were overexposed at various times and something happened. Didn't seem to matter much with the Nasdaq, but outside of this is why we do it. This is why we're measuring this. Okay, so the overall portfolio in that time period made over 10,000, but it could have made 14,000 if we'd managed it. Well, we're never going to remove it all, but perhaps if we'd moved half of that, that's 2,000. That's your ticket back to the UK to go and watch Arsenal play or similar. And so what we can do then is uh, look at various positions and see where, look at this in a bit more detail. So you can see the Aussie dollar wasn't that much of a drama. If we look at individual times when we were perhaps over risk, Aussie dollar's not a problem. Um, if we look at GB pound here, there was a couple of times where it was slightly problematic, but not massive. If we look at the yen, the yen is really the number of times. Where is it? Where is it? Where is it? So you see there, it's the number of times that the yen is overexposed that's the drama. Let's see if we can find that trade. I want to go back further, back further, back further. See, now we're getting into the high areas where the BOJ was messing around with stuff. Okay, so we can do a profile on this, and we can sort of say, right, okay, now we can work out what constitutes high risk and which ones do we want to intervene on. So, and then we can put in a trigger to say, right, if this is high risk, then we limit positions. We're not going to have 14 yen crossing. Bear in mind, this also includes accumulations into positions as well. Does that sort of make sense? Oh, thanks, mate. That's really kind of you. Okay, so that gives you just a little bit of insight. Back to our prezzo. So that is really the way it sort of all works. So we set total exposure limits for our portfolio, and then we say in specific asset classes. So we can block new trades, or what we can do if we get really smart, and this is something that we haven't developed, but maybe is on the list. Or what's something I thought might go on the list is what we do is at a particular level. We don't have to do the no more trades, but what we can do is a stage thing. So we can do a maybe the first three. Let's just take arbitrary numbers. Maybe the first three are um, first three are normal. The next three may be what going to call a clever accumulation or a smart accumulation, where we open small, but we still open a position because our system says open a position, and then we accumulate. We can accumulate into those perhaps when some of the others have pay profits or whatever, and then of course there's absolutely no more. That's enough. Um, I hope that makes sense. Okay, market regime. What I'm calling strategic mismatch. Transition in range from range to trend or change in volatility regime. And essentially, we know that strategies work best in some markets and not in others. But what we do is every time we see a breakout trade, we'll trade it, irrespective of what else is happening. Um, but what we're saying is that there are times when your strategy isn't well aligned with the current market conditions. And if we can detect that in real time with confidence, then we can make decisions from a discretionary point of view, or we can test it with our EA point of view. I'm going to show you a couple of things. So many of you are aware of the market regime indicator that was developed. And what we can do is once we can put that inside an EA, and I'll show you this in a minute, and we can test it and see how well that strategy had performed in various market regimes. So just in case you haven't come across it before, I'm just going to put it on this. Give me a second. There we go. And know me enough for seeing me. Okay. So for those of you less familiar, this is the market regime that was developed. So what it does, we're actually going to put this on a 4-hour chart. And we're going to bring it in a bit. So what it does is it alters regimes. Ignore the white lines because they're period separated. But let's take them out to avoid confusion. There we go. Okay, and so what happens is it changes regime from time to time. So you can see here, this is range bound. It's in a range. By the time it's here, it's in trend up low volatility. By the time it's here, it's trend down low volatility, and it changes and changes. And obviously, this can adjust the time frame accordingly. um, and so on and so forth. Okay. So this is the underlying indicator that we develop that detects regime. Then we take that into an EA. I'm going to show you a couple in terms of what this is about. Okay. So don't worry about the intricacies of this, but just to show you very quickly, I'm just going to make sure that this is visible. Yes, it is. Good. Um, just to show you this, then we'll go to back to the charts. There we go. Okay, so this is a 5-minute gold EA. Um, and it's going to enter point one. Okay, point one of the contract. Oh, we can up that if you want. Make it point two. Okay. And what we're going to do, this is our market regime. So those are our 6 regimes. Uptrend, low volatility, uptrend, high volatility, downtrend, low volatility, downtrend, high volatility, range bound, and trading choppy now. So we've got the indicator, and now we've got something that the market can pick up. So these are settings that we've tested, that we've back tested and worked out the best ones in terms of which markets. So these trade in 4 types of markets, but exclude low volatility, downtrend, and range bound markets. Okay, using a 6-hour regime chart. So what I'm going to do is I'm going to do a test which says what's this like with it on, and what's this like when it's not on. So true or false. So I'm just going to run this very quickly. And this was 2 I just picked out of thin air. I'm going to show you 2 and what they do. Okay, so if we look at the results of those tests, there you go. So this is the regime on. So in this one we got $10,000, and this one we got 4,800 with it off. Look at the number of trades. We've got 1,000 trades here. We've got about 600 there. So it's chopped out all those trades, most of the poor ones. So if we want to have a look at the backtest results of this, isn't that staggering? Maybe I shouldn't have upped it because it's taken it beyond reasonable. But I'll show you anyway. So if we look at the backtest of that result there, you can see the 10,000 profit in 2 years on this one, what was it, 0.2? So we've got to give back 1,000 of that at some stage. There's the graph. Nice equity curve. But obviously it would be significantly worse if we didn't do that. Now, the other one I was going to show you, which is the same. I'm going to do it on the Hong Kong 50. We're going to do exactly the same test. Okay, we'll just make sure that we change this to the Hong Kong 50. So this is a Bollinger Band strategy. So this is the other impact. So, oh, no. Okay, well, let's just do this first. There we go. Let's make sure that we're only testing that, otherwise we'll be here for a while. So again, all this is doing, there's the settings, all this is doing is testing true or false. Is it on or is it off? So let's see what happens. So give it a couple of moments just to do its thing. So there you go. So you see there, it's actually a slightly better net profit. 308 trades and 87. But look at the drawdown. So if we just run this test, this is equity drawdown, okay? So this actually removes 12% from our account. And of course, the trading costs associated with 308 trades rather than 87 can be significant. So if we look at our backtest, this is, so that's 10 times with our market regime added, only 87 trades. So we're saving on commission cost, saving on sanity. Whereas if we do this, we make for an extra $170, then this is what's happening. So we're only making not even 4 to 1 with our risk. All the bounciness in this strategy on the Hong Kong dollar without the market regime indicator. Does that emphasize the point? So we're looking at two distinct things here. We're looking at reducing risk, so um, reducing those times where we really shouldn't be trading. And what that can do is it can either reduce the number of losses that we have, or it can increase our net profit in the trades that we are doing. So there you go. I thought that was worth showing. Thank you. Right. Back to our. So that's market regime. And so although it's looking at the things, although it's looking at one asset and one trade, or one strategy rather than one trade, it's looking at, does that strategy meet the underlying market conditions? And of course, what then should I do? Should I enter or not enter? Right. Okay. So let me just. I thought it was worth referencing the technical infrastructure risk. Now I've split this for you guys who are doing EAs. I've split this into 3 sections, but I've just done it for one for this. Because there's various causes. It can be feed delay, VPS crash, or overload, terminal freeze, internet access, or local hardware issues, or power outage even. The risk, of course, is that orders fail to close, signals are missed, the trade context is over busy, so it just with an overload particularly, it just doesn't operate as it should. The issue with this is detection before irreversible damage is done. So from a discretionary point of view, if your local computer goes down, or your computer blows up, your internet access disappears, have you got a backup system? So this is a really simple, have you got a backup system to be able to trade still? Knowing that you've got open positions, have you got the MT5 app on your phone, for example? So it's really that level of simplicity to put some things in place. Once you're operating EAs, then it gets a little more difficult. So you can do the Python script, of course, operates externally, but you could have, if you like, a heartbeat, a system heartbeat monitor, an alert system for VPS for the MT5 terminal, I guess, as well. Make sure you've got alternative access, so you've got a plan in place if this happens. So it's not just, oh my God, something's happened. There's my notification, ping on my mobile phone. Something's wrong, but also, what are you going to do about it? So you need to have that trigger action. Every one of these, you were looking for what the trigger is and what you're going to do about it. And other fallbacks may help. So if you have the ability to shut down all your EAs at a click of a button, or close down all your trades at a click of a button, and you can get that done, or you know how to do that externally, then that's your obvious complete safety net. But it's worthwhile thinking of. So consider this along with the other risks that we've been talking about today. Just the final thoughts. Of course, we want to stay sane as well as remain profitable. So it's not just about your entry signal logic and your sort of immediate trade standard risk management, such as position sizing, stop losses, trail stops, and profit targets. It's about, I've got several positions open here, each of which can be either one or as a whole can be impacted on events that are not in my control. But you can take control back of what happens when those events happen, and that's your responsibility to do so. And ultimately, as I hope you saw from just that simple market regime example I give you, ultimately it's potentially part of your success. Events will occur. There'll be a once a decade smash to the markets. There'll be a once a year or 2 a year crashes. It's very rare that there's not a bear market once or twice a year, and vice versa, of course, if you're primarily short trading. So ultimately, this is having these things in place is part of your success and your sanity. The more EAs you run or the more trades you have open on your account, the more layers of protection you need. Doesn't matter whether you're an EA or a discretionary trader, you can develop and use primarily automated systems with some sort of modular structure, including EAs, files, so scripts. Um, I meant script and include files that manage intraday, intra-account control, and potentially have Python scripts that pull information from the outside or act as external, if you like, guardians or whatnot. I can think of the right word. I'm not suggesting they wear big black bushy hats and stand outside big parliament buildings or palaces, as happens in the UK, but they can serve that function in terms of making sure you have the right information and making sure you've got something there in place that says, this is happening, or this has just happened, and then you can do something about it. That's the key. Why wouldn't you? Anyway, we are. That's the stuff. So I want you to review the content outlined today. Give it some thinking. Is some of this worth integrating into your trading structure, whether you're an automated trader or a discretionary trader? If you're an automated trader, we're working on that within the group. If you're a discretionary trader, there's nothing wrong. There's nothing wrong with us looking potentially at developing some of these tools which are going to be useful for discretionary traders as well. Give me some comment on that if you have any. And of course, it's not just about saying, isn't that a good idea? It's about taking some action, creating a plan for it, and following through and making it happen. I can't do that for you. I can give you bullets, but you're the ones that have to fire them. So, anyway, that's what I was going to cover today. I hope that's been sort of interesting, useful, and all of that jazz. I don't know how. Of course, if you like what I've had to say and you think it's worth a tick, click that little sort of thumbs up button. It always helps. Um, if there's any questions you've got, of course, you can either drop me a line. I better give you my Gut Markets address. Some of you have got other addresses as well. There we go. So pop me a line at any time with anything you've got to say. Or of course, for those of you part of Discord groups, etc., I can see you in there. I know it wasn't a very sexy topic, but I hope you agree that it was worth doing. And thank you very much for being here. Let me know. Let me know what you think. And I will see you again very soon. You guys take care of yourselves. We'll see you again, possibly at tomorrow's lunchtime session. If you're on the East Coast, 12:30 kickoff. But of course, you can watch it anytime, any place. And we'll see you very soon. Take care for now. Bye bye.